AIM and OTC listed Cadence Minerals, EPIC code KDNC, is an investor and cornerstone partner in the discovery and development of mineral and energy resources. Cadence owns 30% of its flagship Amapa iron ore project in Brazil, and with a recent PFS published, Amapa now has a net present value NPV of $949 million. Cadence recently announced a $2 million loan package with a further $8 million available to draw down to fund studies prior to the DFS, or the definitive feasibility study. The company is also invested into lithium and rare earths projects in Australia, a lithium project in Mexico, and also owns a stake in the operating company for the Sinovac lithium and tin mine in the Czech Republic. I'm joined today by Chief Executive Kiran Morzaria to tell us more. Kiran, hello, how are you today?
Good. Yourself?
Very good, thanks. Very good indeed. Lots to cover today, but firstly, can we discuss the funding package, which has raised a few questions from investors? So firstly, why this type of financing structure? Secondly, will this financing package take Amapa through to recommissioning and into production? And three, why is the share price suffering?
So let's deal with the first one. Why this structure? So fundamentally, we finished the PFS at the beginning, at the end of last year. That was really robust NPV numbers, really positive in terms of its capital expenditure, its unit cost, its capital intensity. If you look at all those metrics, it's a really positive project, and certainly one that deserves to be developed. Now, we have a right of the first refusal to go to 49% in this asset through equity contributions into the asset. But also we looked at our share price and how it had performed as a result of that, and whether that be macroeconomic environments or other reasons, the market reaction wasn't as good as we certainly hoped it would be. So our strategy has been, well, how do we take this further and develop this to the next stage? Now, both ourselves and the JV partners, we've always thought that there are really three ways to develop this further. Firstly, we do it on our own. Two, we bring on an experienced operator or joint venture partner to invest into the project. Or three, a trade sale to someone else who is a good operator and an experienced developer in iron ore in Brazil. So our preference at this point is number two, to bring in a JV partner at the asset level. So to do a DFS, depending on the level, how much, particularly drilling, if you for geotechnical drilling or other types of drilling, that can take $10 million of capital to invest to take a definitive feasibility study. Then after the definitive feasibility study, you build the get the financing and build the project. Now, given our market capitalization and what the sort of private market would value Amapa at, it represents far more value for Cadence shareholders to get a JV partner and an experienced JV partner into Amapa and develop it alongside us while contributing the equity for the development of the DFS and hopefully going towards production. So our raising of this 2 million is fundamentally to complete some studies, carry on the licensing process, and also you basically all to go into the working capital of the operations there. And rather than do equity, we have a balance sheet that we can leverage, and we can pay back that debt at a lower cost of capital than equity cost of capital, through that balance sheet. So ultimately, our view was that by doing debt when we have a balance sheet that can support it, what we're intending to do is unless something quite significant comes up at Amapa, is to really only initially draw down that 2 million and not really touch the rest of the 8 million, and use that to fund, as I said, working capital and development of the asset, in terms of the couple of studies we need to do and getting the licensing so that we can get an operating license for this asset. So that's the reason we did it, because ultimately it's a cheaper form of capital than doing an equity place.
Okay.
Yes, sorry, carry on.
Yeah, so onto the share price. I mean, the share price has really suffered, hasn't it? I know this, there have been. It's a sector-wide issue, certainly, but I think Cadence is on a pretty sound footing now financially. So, what do you think it's going to take to turn things around?
Well, I think there's been, obviously, if you look at the resources sector as a whole and the AIM resources sector over the last year and even the last 6 months, the last year I was actually in the middle of writing the annual report. We were looking at the performance. We underperformed by about 10% comparative to that sector, and that's probably as a result of one, EMH underperforming at that same time. We are linked to EMH's performance, and then more recently, the drop has, I think, primarily due to what Hastings came out with an announcement, and where effectively they're delaying their startup or they're staggering their startup, which doesn't really impact the total cash flow from the project, but it does reduce the NPV because some of the cash flow comes later on. So the NPV came down, and hence their share price came down. So that impacted us as well, because we are a sum of our parts. I mean, and talking to some of our parts, when we look at that, obviously that needs to be updated for the latest moves in that presentation. We can see that if we add the sum of our parts of Cadence, the biggest changes, of course, are Amapa, where we look at a 41 million pound balance sheet on a book value basis, and our cost basis is 16 million. So I think there is, I think VSA put a note about it as well. They were talking about the lack of capital in these resource markets because of the effect of inflationary pressures on people. AIM is, and predominantly our stock is a retail held stock. So you can understand where there is pressure on people's purses. They want to either exit from riskier stocks, which AIM is, and early exploration assets, and these type of assets are riskier than dividend paying stocks. Exit from these and put their money either into cash or something more secure, that it's a steady counter-cyclical type investment, which might be utilities and such. So I think we are overall being affected by that, as you mentioned earlier on. We are subsequently being affected more by certain performances in our portfolio. Nonetheless, we have to remember that despite those, our returns on those investments, both realized and unrealized across our total portfolio, excluding Amapa, like the public listed ones, are in the order of 300%. So we still have good, healthy returns. And they were higher earlier on, but they're still really good, healthy returns. And that's because of our approach of investing, which is investing early and looking at the technical risks and understanding their, and so far our investments on a technical basis have turned out very well.
Okay. So staying with the Amapa, you've shipped several loads from the stockpile at the port, despite fluctuating iron ore prices. When will you start reshipping again?
Yeah, this is a question I often see and get asked. I think we have to understand the fundamental process here. So the material, the iron ore there is a 58% material, and I've seen comments and saying, well, why aren't we shipping it when other people from Amapa are shipping their material? Because they have a higher quality material. They have a 65 or a 62% material, and that gets about a 15% premium over ours, or ours is a 15% discount, and that's $10. And so $10 is 450,000, almost $500,000 in terms of an extra revenue on one shipment. So we haven't been shipping because although it's commercial, it's not commercial enough for the banks. And I say that very clearly because ultimately we reached a settlement with the banks, and they have the security over the stockpile. Any proceeds from that stockpile goes to the banks as part of our settlement agreement. And as much as we can recommend to sell that stockpile as commercial, the banks have that decision when they can decide, well, actually, we think the pricing maybe go higher, and therefore we'll wait a bit longer. So that ultimately they are, as much as recommendations we can make and think this is the right time to sell, they are the ones that get the revenue from it, so they can decide when to sell it. It doesn't make a difference to the operations at Amapa. What it does do is, as they sell it, obviously reduces the liability that Dev has to the banks.
Of course. Okay. So you've touched on this already, but you said previously that when the mine is up and running again, gross annual revenue revenues could be as high as $725 million once back in production. What steps do you need to take now to get to that point?
Very much a typical steps in terms of a development of any asset of this size and complexity, or any mining asset, which is, in essence, we have to carry out a DFS. We've got some studies that we identified as a result of PFS that we've already had reported the results on those, and where we've found a capital saving of about, I think it was $23 million on the railway. But there are a couple of other studies which can improve that NPV and revenue further, and obviously free cash flow to equity. But after that, you would embark on a definitive feasibility study, which will take about a year, and then about a 2-year reconstruction, recommissioning. So that is the same for all mining assets pretty well of this size and this complexity. You've got to remember that a mining asset typically takes 10 years to develop from early stage to production. And what we've shortcutted here is, we got ownership of this in January last year, when we finally settled with the banks, and we basically shortcutted 5 to 6 years of that development timeline. So now the development time is standard, and as I said, our idea is, and I think our plan, the most sensible plan, we believe that will provide the most value to shareholders, is to get a JV partner involved into the asset. And we are in active discussions with several possible JV partners. We have a data room, and that's ongoing in the background, and I hope to be able to report on that when we get some further news on that. So that is the development timeline that we will do. That's a development process that we will do on in that regard.
Okay. Now you've of course have spent a lot of time in Amapa. I've interviewed you there direct from the Santana port. What changes have you seen there over the last year, Kiran?
Well, over the last year, I think the most, when I first visited there, the port was in absolute shambles. The mine was unsecured. There was theft of materials. And there was the dams were unsupervised. So that's all completely changed. So we've completely, obviously, the port, you can see from the pictures, have been improved substantially. We have infrastructure. We have people involved in ensuring that the mine is secure, the dams are secure. Obviously, the last year was heavily involved with the PFS that we did in 1 year. And now we are focusing on, with people to divert, focusing on the basically environmental permitting. So when you, as part of a DFS, you need to have, if it's what they call in Brazil, what I would suggest that we need to have is an installation license, which is the right to construct your mine. Now, because historically the mine went into receivership, those licenses were suspended. So we are doing the relevant studies. So we've already started we started the studies last year in terms of the environmental studies to get those installation license or operational license granted during the DFS study. So that's what we're really active at the moment, and we're also active in engagement with social engagement and government engagement, which is sort of much more the soft part, but it's also a really important part and critical for any potential JV partner or financing to come on board. Not only have you got the technical study sorted out, but you have all of these other aspects of the mine and project resolved, or a very good permitting pathway sorted. So this is, although it's not as exciting in terms of delivering NPVs, without this sort of work, no mine gets developed properly. Without, you need your social license, you need your permitting license, and all those are what's happening at the moment.
Understand that. Yeah. Okay. So on to the other investments now, Kiran. You've of course got lithium assets. You have an 8.7% stake in ASX listed Evergreen Lithium. It's just recently come to market, and of course we've already touched on Hastings Technology Metals, where you have a 1.7% stake there. What's the plan in terms of selling these down as you go forward to realize value?
So the first one, we certainly can't do anything with the one at ASX on the Evergreen one, because there is a statutory lock-in or a ASX lock-in required for all founding shareholders for 2 years. So certainly we will have to see how that develops. Actually, that's actually, that's when you really want to be holding the stock as it's drilling, and that's where you see sometimes if it's successful, the biggest increase in value. As opposed to, as we look at Hastings Technology Metals, ultimately although it has gone down, we probably now, our unrealized gain is about 100% instead of maybe 300% as it was earlier in the year because of what I just mentioned earlier. Not going to disclose effectively when we're going to sell it and how we're going to sell it, but ultimately, the idea here is we have created some value here. We think that Hastings will return in some form, the price will increase. But our idea here is to minimize the requirement from our shareholders, utilize the returns that we have gained from these to reinvest in assets, primarily, something like Amapa or Amapa itself, to get the same sort of return again. So, we've invested about 9.3 million into Amapa as of the end of last year. We're going to be investing a further 2 million into Amapa this year, so which is what we did the funding for. So that increase, if we get the same type of level of return, 300, 400%, is actually a big improvement further to our investment or on our balance sheet. So, that's what we're trying to achieve here, effectively, eventually having a self-fulfilling cycle by buying in early, doing the technical due diligence, seeing those values increase, which they have across our investments about 300%, and just in our public stakes, and then reinvesting that to grow it further. Ultimately, to carry on growing it on a regular basis to deliver capital growth in our shareholders, not only on our investments but on our share price as well.
Okay. So two other investments to look at. You of course got 30% stakes in 2 concessions at the Sonora Lithium project in Mexico, now owned by Ganfeng, of course, and you've got a 6.8% stake in European Metals Holdings (EMH), which is of course the owner and operator at the Sinovac lithium and tin mine in the Czech Republic. How are those two progressing?
So the first one is the Mexico concessions, and I think from 2021 the Moreno government came out with calling lithium a national asset. So I think we were all quite nervous at that point in time about what was going to happen. But I think since then their stance has softened, and they've said that even though there's a lithium reserve which covers those concessions, as well as a Ganfeng's concessions, they say that as long as Ganfeng and RJV abides by the mineral concessions and the laws, that those will still be reserved. So our view, and I believe Ganfeng's view, is that ultimately those concessions are still valid, and I think it's really up to Ganfeng to communicate when they're going to develop those. Our assets, those 30%, really only get developed in the latter part of the mine life. So it really doesn't impact us right now. But ultimately, I personally think if it hadn't been for the Moreno government and their decision to do that, I think that those assets would be already in construction. But unfortunately, geopolitics has interfered in this case. I still think that it will be developed because it's such a substantial asset. It's really close to America, where we have a really big incentive, and the amount of battery plants being opened up there is huge. They've overtaken Europe in terms of the planned gigafactories there, so they're going to need sources for that. And this deposit is a multi-generation deposit, one of the largest clay deposits, hard rock deposits in the world. And yes, it has got a 21-year mine life, but it's still got another 40 years after that, which of the majority of that would be in our concession. So we are positive about it, but I think it's going to be a slower and longer burn on that one.
Okay. And Sinovac?
Sinovac, well, I think they published just recently a really good set of results on their lithium recoveries. They confirmed that their DFS will be ready in Q4, I think, this year. So we'll look forward to see what that DFS looks, but I think it's obviously going to be really positive because lithium prices improve. Let's see how their capital and OpEx cost changes. We have, again, reduced our stake in that, reduced our exposure, partly because of dilution. We have been diluted during the period of time last year, and we have sold down our stake. But that sold down our stake has been investing in our assets. So that's doing what we said on the tin in terms of investment strategy.
Very much so. And of course, going forward, presumably you have other projects crossing your desk all the time. Have you got any shortlisted that you can look at? You can tell us about?
We have plenty of assets that come across our desk, and I think our investment strategy really, we look at the technical risk and the development risk. I think if I was looking at stuff, I'll be specific about anything, it would have to be hard rock lithium, to be clear, and it would have to be in a area that has got a relatively stable jurisdiction, like Brazil or Europe, and it would have to be early exploration to sort of get us that uplift. I think at the moment we're focusing on these assets that we have, but we do see plenty coming across our desk when we do our due diligence. And I think the specifics about what type of asset we'd invest is sort of look at stable jurisdiction and hard rock lithium, because they're easier, quicker to market, and that's where we feel the shortage. I can see new projects coming in the lithium sector post 2025, post 26, but there's a gap to be filled between now and 2026. So and hard rock lithium is easier to develop because literally you're not doing if you get a good deposit, you're not processing it. You're doing very much an iron ore processing and then shipping it to China to get converted into lithium carbonate or lithium hydroxide.
Got it. Okay. Well, the Amapa certainly looks set to be an absolute monster when it comes on stream. We wish you every success with the recommissioning there, and of course in realizing value from the Cadence portfolio. Kiran, many thanks for joining us today, and hope to speak to you again very soon.
Thank you, Alan.